Hi, I'm Ben Reppond. Today is April 5, 2022. We're going to cover several subjects, and we're going to begin with food shortages. So this is not the Food Channel, but we're going to get into various aspects of food shortages, causes, effects, U.S., China, etc. So I'm going to begin with, this is what caught my eye on Bloomberg. This is an opinion piece. One reason for rising food prices, Chinese hoarding. Caught my eye. Now, hoarding is a pejorative, so we could say accumulation or stockpiling. Maybe those would be easier words, but the reason for rising food prices, the article says, is Chinese hoarding. Now, this is from the Chinese government, but it's going to go on into the Chinese people. So, but this will affect the U.S. food supply, inflation, other things that we tend to cover. So the subjects are interconnected here. This came from the article, and it is, source is Bloomberg. Their source is the U.S. Department of Agriculture. In the area of food, they cite China is hoarding 70% of the world's corn, 60% of the world's rice, 51% of the world's wheat, and 46% of the world's soybeans. When you go over into the area of commodities, they are hoarding 80% of the world's copper, 70% of the world's crude oil, think about that, and 20% of the world's aluminum. These are products that are found, or commodities found in most products that we buy and use, and of course the food is the staple for a lot of the world's food supply, being hoarded by China. They have asked their residents to hoard, accumulate, buy food, and the question you'll see, I'm going to play you a clip, and you will see from this clip, the question is why? Why are they doing this? Well, the people are responding, and they are buying up food, but we don't know why. But so listen to this clip. This will be a couple of minutes, and this is put out by a news source from India, which is covering the issue in China, and they provide captions so that you can we can understand in English. Here we go.
Food sensitivity is a serious issue in China. In the past, the country has dealt with numerous famines and droughts, some so deadly that they have cemented a place in history, due to which the Chinese do not take food supply so lightly. However, in the last 1 week, a new concerning trend has emerged in the Chinese mainland. People are stocking essential supplies. They are fighting for food. Army biscuits and luncheon meats have become the most searched items online. Rice, soy sauce, chili sauce, noodles are trending on Alibaba. The top search on a search engine reads household stockpile list. Guess what's happening here? The Chinese are stocking up. They're buying cabbages, rice, sauce. Vendors are running out of their backstock. This begs the question, why? Why are people fighting for ration in China? Is China running out of food? Or is there something worse in store? It all started last week when, in a notice, China's Ministry of Commerce encouraged people to stock up. The notice asked local authorities to ensure that there are enough supplies so that people can stock up. Let me read this out for you. The notice requires that all localities support and encourage large agricultural product circulation companies to sign long-term supply and marketing agreements. Storage-resistant vegetables should be purchased in advance. The supply of goods should be locked in order to prepare local dishes and customer dishes. It goes on, and I'm quoting here, encourage families to store a certain amount of daily necessities as needed to meet the needs of daily life in emergencies. Strengthen the construction of emergency delivery networks. It does not say why. The question that now arises is why? Why does Beijing want people to hoard food supplies? There are multiple possibilities here. For starters, people fear that China might go into lockdown again. China is in the middle of a Delta outbreak. Daily infections have touched a 3-month high. Several Chinese cities are under lockdown. But it is very unlike the CCP to risk its position by sending any sort of signal that can be read as a food emergency. China never asked its citizens to stock up, even when it put millions under lockdown in 2020.
So, thinking about China, people in China are being locked into their apartments or homes from the outside. The Chinese government is locking people in their homes. Why? Well, I don't know why, but that's happening, and I'm thinking from just following my mind here, if people are locked in, they're going to starve to death. They may have water in their apartments or homes, but they only have so much food. So I don't know how long the lockdown is going to go, but they were particularly talking about Shanghai. 25 million people in Shanghai being locked in their homes and apartments. I don't know how far widespread it is throughout China, but this is definitely happening. Throughout the world, but in America in particular, the cost of food is partly due to the cost of transportation. So yes, there is fertilizer, seed, labor, etc., but transportation is a big part of the cost of food. So what's going on is the cost of diesel, and I'm aware of this because I drive a diesel truck, so the cost of diesel supplies all of the equipment on the farms, the tractors, the harvesting equipment, the processing equipment, loading, etc., all diesel. And then trucks, diesel trucks, are hauling the food from the farms to the processing plant, to the warehouses, to the retailer. So there are 3 steps where diesel trucks are involved. And the cost of diesel where I live is about $5 a gallon, and the cost of regular is about $4 a gallon. So $1 more for diesel. That's higher than normal and seems to be going up at a higher pace than regular gasoline. But the cost of diesel is affecting not just food, but everything, the transporting of goods, etc. So we're 80,000 drivers short for truck drivers. The cost of diesel is very high and getting higher. And this goes, from the farm all the way to the retailer. So I saw this article. It says basically that Russia is playing politics with their food supply. Russia produces, I think the country of Russia grows across 6 time zones. It's a very big country. They're determining who gets their food and who doesn't. Those who are friendly to them, according to their defense minister, are going to get food, and those that aren't are not going to get food, or at least they're going to favor one versus the other. Could we survive without food from Russia? Wheat, grain, soybeans, corn, etc.? Yeah, probably. But it's going to force the cost of food up in the U.S. if we don't have that food supply. Who are they going to supply it to? Well, they don't really say. They just say those that are friendly to them. So we know for sure that would include Iran and China and probably some other countries. It probably would not include the U.S. Haven't seen politics, food being used to favor political leanings. If you have the ability, this is up to you. I'm not going to tell you what to do, but if you have the ability to produce your own food, to grow your own food, and you do that, that's great. If you don't do that, you can think about it. It depends on where you're situated. If you're in an apartment or a condo, maybe not. But in those situations in cities, I saw this in Seattle, there are co-op community areas for people having plots of land to small plots to grow some crops for themselves in kind of a self-sustaining cooperative arrangement. If you have a home that has limited amount of land or you have HOA restrictions, maybe you can't. But what you can do is this. In every area, even in big cities, there are farmers markets, and you have the ability to do food share. You can buy a food share. What is a food share? It is where there are farmers, usually they're organic farmers, who grow crops in areas, and you can contract with them to buy boxes of food weekly. So what we're doing is we're letting our land set fallow this year and give it a rest and then resume next year. So this will be the first year that we've actually relied on a local farmer for a food share. So I learned about it. So we paid $575 to a local farmer, and for that get a box of food once a week for 20 weeks during the growing season. And something like this. And it'll be whatever's in season at that time. You just get a variety, and you can eat that food or you can store that food or some combination thereof. So that's available in virtually every area. I checked several areas, and you can participate in a co-op food share, or you could go to the farmer's market where you live and buy food and during the growing season. I see it as the opportunity to build a relationship, to have an arrangement, get to know who the farmer is, maybe go to their farm, build that relationship, because if we get to the point where there really are food shortages, there just is not enough food, you want to have a relationship with someone where you can get that food or where you can grow it yourself or some combination thereof. So something to think about. So could we have, in America, shortages enough that there is actually, you can't buy food at any price, or it is so expensive that only the wealthy can afford it? This is happening in the world right now. It's not happening yet in America, but we are at a tipping point. We're not far away from this. So I'm thinking, starvation, and if people are starving, what will they do? Desperate people do desperate things. So could we have anarchy? Could we have riots? Could we have civil war? Could we have those kind of things? We haven't had that much in this country, certainly not over food. But we're, in my opinion, I think we're at a tipping point as I read what is going on around the world. I've shared some slides with you about Russia and about China. And China owns 192,000 acres of land in America. What are they going to do with that land? The crops that are produced from that land, are they going to provide it to the Chinese people or to the American people? Just asking a question. Not sure. But this is an avenue. So if you feel like you're not in a situation where you can grow crops, there are options for you. So are you looking for some good news? I thought I'd give you some good news and not just all bad news. So the jobs report was favorable last week. The goods producing sector, the sector that produces products, grew by 79,000, and the service sector grew by 377,000. Okay, now over to mortgages. More not so good news. Mortgage rates are up. So they are up to the 30-year mortgage is up to a rate of 4.67%, up from just the beginning of the year, up from about 3.2%. That's a lot in 3 months. Last year, back I think in the summer, sometime mid last year, the 10-year rate was down as low as 2.5%. But so this is up quite a bit. and seems like it's going higher. What are the implications? Well, those who are, if you have a mortgage, I think a good goal would be to pay off the mortgage. And if you're able to, that would be a goal, or move in the direction of paying it off. And but the idea of having a second home, nothing wrong with having a second home, but getting a mortgage on that second home, thinking if you have a mortgage here and you have a mortgage here, it seems to me that if you're doing that, you're going in the wrong direction. But it says, in this article said, that there is a drop in demand because people can't get mortgages on their second home, or at least it's more expensive due to the fact that rates are up. Well, I'm thinking, why do you want, if you're going to get a second home, why do you want a mortgage on it? If you can afford it, then buy it. If you can't afford it, then don't do it. That's the way I'm thinking, because if we're heading into more challenging times, and I think we are, thinking in terms of that luxury, that's fine if you can afford it, but if you can't, I don't know, I wouldn't get a mortgage. So, but anyway, demand for second homes is down. Now, last week, it was announced that we are, as a country, we're tapping into our strategic oil reserves because of the cost of fuel and soaring prices, inflation, etc. So I understand that. So we have released 180 million barrels, or prepared to release, allocated 180 million barrels of oil, according to the Financial Times, at the rate of 1 million barrels a day. So 1 million barrels a day for 180 days, so 6 months approximately, we're going to release 180 million. But I'm thinking, okay, that's fine. I don't think we're in an emergency, not that dire. I mean, yeah, prices are up, but that's not a national emergency yet. But the question I have is, that was not addressed, and I don't think there's an answer to it. What are we doing to replace that? Because we need that, and that's about a third of our reserves. So a third of our oil reserves are being released because prices are high and because Russia this and Iran that. Like, wow, didn't seem like an emergency to me, not the way I think of an emergency. So, but if it is an emergency, what are we doing to replace it? Nothing. So we have plenty of oil. We can be energy independent. And were we drilling for oil or bringing it in from Canada more or something? No. We're just sitting on lots of oil and are putting up with high prices, depleting our emergency supply with no plan to replace it. Kind of reminds me of the national debt. Okay, recession. There are countries around the world that are in recession. When you measure it by real GDP, gross domestic product. So those that are pink or red or brown are in a negative growth. In other words, everything in pink and red is in a recession, measured by real gross domestic product, adjusted for inflation. So buying power of the dollar, or buying power of the currency. Those that are not in a recession are in yellow, or yellow and orange, which includes China. Their rate has come down from a 10% growth. Now they're down in the 2%, 2 to 2.5% range. So they've come down a lot, but they're still positive. The rest of the world, including the U.S., is in a recession measured by the buying power of the dollar. This is an important slide. This slide and the next slide are very important. So, and they're strategic. They're macro charts. This one is a little more micro, but the next one will be macro. And this is a subject that most people are not aware of because it's kind of gets into the weeds and it's financial and it's complex actually. And so, but I'll try to make it as simple as I can so that the average person can understand it. This is the relationship. This is a chart on the relationship of the yield on the 10-year government bond and the yield on the 2-year government bond. And the 10-year yield on the 10-year would be the numerator, and on the 2-year would be denominator. So the relationship of these. So when the spread, the difference between those two, drops and gets to a negative point, this is called the bond yield spread. And you might have even heard the term the inverse of the bond yield. When it goes negative, when this relation, when the 10-year bond yield drops to a negative number below the 2-year yield, then it's called an inverted yield curve. In other words, and this has happened 6 times in the last 50 years, maybe 7 times in the last 50 years. And I'll show you that chart. When this happens, a recession is coming. It has been 100% accurate and the most important predictor of a recession of any economic indicator. Now, I'll give you a little bit of good news here. It's not right away. So an average might be 9 to 12 months away. The soonest it has ever occurred has been 6 months away, and the furthest away is 24 months. So if you think in terms of, let's just say a year from now, it could be, it's never precise, so it could be a little sooner or a little later, but a year from now, a recession is coming if you rely on the data for the bond spread between the 2 and the 10-year yield. There's something about this, and I don't want to get into the reasons for it because that gets more complicated, but that this is a predictor of a coming recession. So if you have the feeling that you're waiting for the other shoe to drop, it feels like there's a lot of big uncertainty and something bad is about to happen. I don't know what that is. I certainly have that feeling. It feels like something around the corner is going to happen and it won't be good. So I don't know that that triggers into a recession, but it could. So here is the macro chart. And this is from the Federal Reserve Board of St. Louis, which Federal Reserve economic data. And I put the red arrows in to show you the last 6 recessions, or the last 6 times that the yield went, 10-year yield went negative relative to the 2-year yield. If we back the chart up just a few more years, this chart goes to about 1975. If we backed it all the way up to 1970, just 5 more years, you would see another arrow. So it actually happened 7 times, and this being the 8th. Now the chart I just showed you, if you just took a slice, at the very end of the chart, you can see the previous slide. That's what that looked like. And so here we are, the yield has come down very quickly, or the difference between the two has narrowed and has become the same. There's parity between the two. Right now, this happened Thursday. So could it go from here? It ended that day, Thursday, actually, slightly positive, but during the day it went negative. So could it bounce from here? It could, but my experience in dealing with data like this is that when something comes down that fast, it usually keeps on going for a while. So if I had to guess, I'd guess that we're at some point in the coming weeks or months, this is going to move on into a negative territory. I don't know that for sure, but but already you could say we have an indication that a recession is coming in 6 to 24 months if we rely on previous patterns as an indicator. It's not a guarantee, it just has been 100% accurate for these last 6 times. This is still dealing with bond yield, but I want to get to another point. This bond yield, this is the 2-year bond yield, so which is kind of part of that previous chart, the relationship of the 10-year and the 2-year. The 2 years going up and the 10 years either coming down or it's going up at a slower rate to the point where the spread is gone. There is no more spread. So when there is a spread, it's a healthier economy. The spread's gone. Here is the 2-year yield, 2.36%. It is up from about 20 basis points, up to about 230 basis points in, what's that, less than a year. So it's moving up quickly. What does that mean? What it means is, and this is my point, what it means is that the bond prices, or bond fund prices, are declining. And those are an important part of most people's portfolios. We don't use those, but we got away from that about a year ago. I could see this coming, that this was not a good picture because interest rates had bottomed and were going to, in my book, seemed like they were going to go up before they started to go up, but you could see it because when they're that low, at some point, something is going to trigger them to go up. So we got out of it, but traditional advisors and traditional portfolios typically, the older you get, the more they put bonds and bond funds and ETFs. Sometimes they're not even called bonds; they're called something else. But they're in the portfolio, and it puts a huge drag on a portfolio when the bond prices start to decline. This week, I got I'm on the distribution list for a financial advisor who happens to also, he's at a pretty high level, he owns some exchange-traded funds and some mutual funds. So he's got his own basket of assets, and that's fine. And I know him personally. I was on a panel with him a couple of years ago. He's a good guy. I like him. And he's extremely honest. And he sent this out. I'm going to paraphrase part of it, and some of it's verbatim and some of it's paraphrased. And he's extremely honest in sharing his feelings about what's going on. So I'll read this, and bear with me while I read it, but I think it's indicative of financial advisors who are caught in this situation with having recommended bonds, and their clients are sitting with bonds, and it's a very difficult spot. So this says a lot, and there's quite a bit of emotion in here as well. But he's writing this, so this will be in the first person coming from him. He says this: "This is perhaps one of the most important emails I've ever written. Many people are wondering why their investments have performed so poorly this year in 2022. No one is more disappointed," he says, "in the year-to-date results of my results than I am. This year has been a miss." I said miss, but he could have said mess. "A significant one. Government bonds have not behaved as they have in the past. Quite the opposite. The government bond index has recorded its worst start to a year in all of history. According to Barron's, the 10-year Treasury note," we just talked about that, "is suffering one of its worst starts to a year in 2 centuries. That's 200 years. This cannot be understated. What has happened this year is not normal as stock market corrections go, because government bonds have crashed alongside equities. They have become correlated. They have both dropped together." Let's consider the relationship between stocks and government bonds. Over time, These two assets have historically been inversely correlated. When stocks go down, government bonds tend to rise as investors rotate into safer assets. Conversely, the opposite also tends to be true. When stock prices are rising, investors often have less of a need for defensive assets. I agree with that. That's commonly agreed upon. That's not, however, been the case over the past year. So not just for 2022, but over the entire past year. And year to date, now he's jumping to just 2022, year to date, 2022, from January 1 to March 14, which I think was when he might have written this, long-term government bonds have lost nearly 9%, while the S&P 500 is also down 12%. It has been a very challenging market for investors as well as financial advisors, and I would say traditional financial advisors. The traditional approach to investing has become harder and harder to protect client assets. At least he's being honest. And I have had people tell me that their financial advisors have said, given them sound bites of, this is going to pass, this is transitory, hang on, you can't sell now, et cetera, et cetera. And it's not very comforting when you see your portfolio down a substantial amount. And I saw this article on CNBC. Financial advisors are more stressed out than their clients. They've got the weight of those portfolios on their back, and they're stressed about it. I do understand that. And he was voicing that as the manager of a mutual fund, an exchange-traded fund that included bonds. And what happened in the past is not happening and going to happen in the future. And the reason is simply this: rising interest rates. So this cartoon, I thought it was cute. So I spoke to my financial advisor, and everything is on track. If I stay the course, I should be able to comfortably retire about 108. Crypto during the first quarter of 22, while equities declined quite a bit, as I just read to you, so did crypto. Crypto came down. Crypto was not the counterbalance to stocks that people were hoping. Why? It's not backed by anything. There's no real asset there. On the other hand, gold held its value during that period of time. Okay, now I'm going to go over to the stock market and give you some indicators and some charts. So bear with me. So this is a dashboard that I put together that compares the 4 major U.S. indexes and 2 foreign indexes. So at the top we see SPY, which is the S&P 500, and to the right are red and green dots. The green dot means that it is above its 20, 50, 100, and 200-day moving averages, or it's not. And it's in that order, 20, 50, 100, 200. If it's a red dot, it's below the moving average, which is not a very positive sign. The S&P 500 is above all 4 of its moving averages. DIA for the Dow Jones, IWM for the Russell 2000 small cap, and QQQ for the NASDAQ 100, the largest 100 companies on the NASDAQ, are all mixed. 2 above, 2 below. Then when we get to the foreign markets, the emerging markets and the developed markets, both of them are fractional as well. Some above some of the moving averages, 20 and 50, below still the 100 and 200-day moving averages. So this is a mixed chart. The S&P 500 would be the most positive thing on this chart. The next chart is a chart of sectors, and these are the 11 sectors, major sectors in the U.S. economy. And what I did was I looked at last week's chart and this week's chart, and I compared them. And last week, there were, just using green dots as an indicator, there were 36 green dots. There are 28 green dots as of Monday, April 4th. A reduction of 8 green dots. So these are the sectors that are above or below those same moving averages. The amount of green dots would, and if it's broad across all of the sectors, it would show market breadth. That in a rising market, which we're in right now, the more it can affect multiple sectors or all of the sectors, the better. But those that are above the moving average, all of their moving averages are the ETFs, are energy, real estate, basic materials, consumer staples, and healthcare. Those that are below their moving averages, the most below in the yellow box at the bottom, are the industrials, retail, and financials. So it's a mixed picture. And so it is showing a reduction in the market breadth. And so that's not a positive sign, but the growth is affecting certain sectors and not others. This is a chart, get into some charts now. It's a chart of the S&P 500 represented by the ETF SPY. And this is a weekly chart going back for the last year, applied to its 20-period moving average. So one movement, one change represents a week. There are 52 of them. And so you can see that there was a trend going up until about 3 or 4 months ago, and then the trend, 4 months, beginning of the year, the trend clearly went down. And now at the end, I circled this, since the middle of March, the trend is up. So crossing back up above the 20-period moving average. So positive direction. Is this a formation of a new trend? It could be. It could be a continuation of a trend, a longer-term trend going up. But we don't know that yet. We just know that we have a short-term move in a positive direction. This is a relative performance chart showing the growth stock index, VUG, Vanguard Fund VUG, relative to SPY. So it's the relationship of those two ETFs. You can see that this moved in a positive direction up until November. That would mean that since VUG, growth stocks, are the numerator, this would mean that growth stocks were in favor up until about November. Then from that point forward, the S&P 500 was more in favor, which means the line went down. So if we inverted that and made SPY the numerator, it would be the opposite. So SPY has been in favor relative to growth stocks since November. Then at the bottom of the chart, now, remember the chart I just showed you, now we see the growth stocks starting to outperform the S&P 500. So not yet above its 20-period moving average, but showing a positive direction for growth stocks, generally speaking. But we're still part of that long-term, we're sort of breaking that long-term trend down that was not in favor of growth stocks. And we're sort of breaking that now, and looks like it's the beginning of a trend that will favor growth stocks. This shows the small cap index represented by IWM, ETF, IWM, relative to SPY. So IWM is the numerator, SPY denominator. So as it goes down, what this means is that small cap stocks have been out of favor for a year relative to the S&P 500. Whether they both went up or they both went down or one went up and one went down, doesn't matter. It's the relationship of the two. They could have both gone down, like for example, during the past 3 months, they both went down. But in this example, the small cap stocks went down even more than the S&P 500, which is mostly large cap stocks. This is the government bonds, the long-term government bond, TLT is the ETF. And it's a 24-month chart, still a weekly chart, but spanning a 24-month period of time. And I circled these periods of time so you could see this long trajectory down. Now, I've been talking about bonds and the impact on portfolios, and this is an example. The intermediate term bond and the short-term bond look the same way. They just don't move down as far. But the same pattern exists with the other bonds. And it's not a good picture for traditional portfolios. Gold. Gold represented by the ETF GLD over a 24-month period of time has generally moved up. It has, you can see at the right end of the chart, had a little bit of a tick down, but the 24-month trajectory in general is up. When I did this on silver, represented by the ETF SLV, same thing. It general direction up, but for the last year and a half has kind of moved sideways, maybe down a little bit. But the longer term trajectory is up. This is a chart where I put silver in relation to gold, a relative performance chart. Silver being the numerator, gold being the denominator. So you can see over a 24-month period of time, this favors silver. If it's moving up, it favors silver. However, in the last year or so, the red arrow pointing down favors gold. So in the last year or so, gold has actually outperformed silver a little bit. This is the volatility index. It's known as the VIX, or VIX is the symbol. And it is an index that shows volatility in the market. So it kind of works a little opposite direction from the market. As the market is going up, there's stability in the market and lower volatility. Volatility usually means negative volatility. So as this comes down, usually that means that equities are going up. And there is a benchmark. I put a black line on here because it's around 25. You could say it's 24 or 25. When it drops below that, that is a good sign for equities, particularly if it's moving down as opposed to moving up. But if it's moving down and has dropped below 24 or 25, that is positive, and that is the degree to which it is now below 25 and seems to be moving in a downward direction. So this is a positive sign for equities, and we shall see. I mean, as you can tell, it does change direction from time to time, but we're in a positive direction for equities at the present. Asbury Research does, I'm going to show you some of their indicators. This is their Asbury 6 internal market metrics. Those are all positive. Six out of 6 are positive. This is the asset relative performance, how certain sectors or assets perform relative to other assets. And during the last week, there is not a clear direction. Now, I showed you my dashboard, and you could see that some of the sectors there are fewer sectors. There are 8 of them that have dropped below a moving average. So during the last week, this indicator is mixed. If you look further out for the last month or the last quarter, you can see that stocks favor bonds, low volatility over high volatility, large cap over small cap, S&P 500 over Dow, so that would be a broad market versus a value market. NASDAQ 100 for that period of time actually was favored the S&P. Growth over value and the U.S. markets over developed markets and emerging markets. On the fixed income or bond side, corporate bonds favored government bonds in all three categories. So interesting, a mixed story, particularly in the last week, it's mixed. This is not performance-based, this is asset flow-based. So this is where the money is going. Whether the performance is there yet or not, the performance should follow the emergence of large money, large institutional money going into assets. This is a completely mixed bag. The red sectors show where money is coming out of, and the green shows where money is going into. And there's the top two in each period, the weekly, the monthly, and the quarterly. You can see that money has come out of financials and out of energy for the last week. And it has gone into technology and consumer discretionary. Those were very much out of favor just a couple of weeks ago, but now have come back into favor. U.S. versus the world. These are 3 South American countries plus Australia, or Latin American countries plus Australia. Chile, Mexico, and Brazil are favored performance-wise over the U.S., and so is Australia, over the U.S., and the rest of the countries. There is not enough movement of money to say, performance to say that the U.S. is really strongly outperforming or the other countries are strongly outperforming. But if you look at the weekly, the U.S. only appears once, and that is relative to Russia. But strongly, Chile, Mexico, Brazil, and Australia are favored in all 3 categories. I thought it would take, last week I did Mexico, this week I'll do Brazil, just to show you from a relativity standpoint why Brazil would be favored in the last week, the last month, and the last quarter. So we're looking at a fairly short period of time, but to say what is going on that's causing these countries, I'm just going to pick on Brazil, but what is causing these countries to outperform the U.S.? In my opinion, when you look at all of them, what do they have in common? They all are commodity rich. They're rich in commodities. This versus that, but some. But Brazil is a commodity rich country. So this tells a story. This is the last year. So you can see Brazil outperformed the U.S., and then it underperformed the U.S. from June to the end of the year. And then since the end of the year, when the S&P was mostly going down, commodity-rich Brazil, as well as the other countries, all began to emerge and do well. So yeah, they may be a developing country, but in periods when commodities are needed, they do quite well. Gold and silver. As of Monday, April 4th, the gold is down 0.2%. Silver is down 4%. 1931 and 2446. This is not a reflection of supply and demand. This is a function of manipulation, and the supply and demand comes on the premium or commission that you pay on top of the coin itself. That's it for today. Thank you for watching, and if you have questions or comments, I will look and will respond to each one of them. Thank you again.